At Quantum Advisory, we believe that for charity trustees, when it comes to investment, if you're to spend time focusing on one thing, it should be getting your investment strategy right. More and more, we're seeing charities focusing on this area. I'm Dan, and I'm Head of Investment Strategy at Quantum. Why are more charities choosing to focus on investment strategy now? There are a few reasons for this. The first is regulation. So the Charities Commission issued their updated guidance for trustees on charity investments in 2023, commonly known as CC14. So whilst larger charities will be familiar with running their own investment arrangements, the new guidance has made responsibilities clearer for smaller and medium-sized charities, who will typically have less in-house investment expertise. We're finding that these charities are starting to recognise the importance of seeking independent expert advice to help with their investments. The second reason is that charities are facing a range of pressures now, which run the risk of adversely affecting funding. For example, the cost of living crisis has put donations under pressure, whilst also increasing outgoings. Linked to this, government spending is also being squeezed, affecting those with government contracts. In this environment, an effective investment strategy is another tool that can be used to protect charities against short-term pressures. So the final reason is that we've seen a number of shocks in markets in recent years, including equity market crashes, inflation spikes, and substantial interest rate rises. In addition, there are also a number of secular risks potentially affecting short and longer-term performance, such as geopolitical volatility and climate change. Against this backdrop, it pays to think about risk management in your portfolio. Whether you're looking for a more bespoke strategy or a more low governance approach, we believe that the same principles to strategy design apply. The key to strategy is an understanding of your objectives. So for charities, these can typically be separated out by time horizon. So thinking about the short term, the focus is on meeting obligations. These can often be known with a reasonable degree of certainty over a period of a few years, and the charity will want a high degree of certainty when it comes to having cash available to meet them. For that reason, I would say that we have a relatively low risk tolerance over the short term. Moving on to the medium and longer term, now in most cases, charities are looking to manage their assets in perpetuity to support their charitable purpose, seeking to protect their purchasing power, which is why we often see charities adopting an inflation plus investment target. It's important that meeting short-term obligations does not compromise this long-term objective. Underpinning all of this is the charity's investment policy. While it's not the focus of this video, in particular, trustees will need to consider what their approach is to environmental, social, and governance factors. This may lead them to favour certain asset classes over others, ones which are easier to invest in a manner which is consistent with their investment policy and charitable purpose. Having outlined the main objectives, in order to meet these, our approach at Quantum is to use three main building blocks. For this example, I've used allocations to target a long-term expected return in the range of CPI plus 3 to 40%, but the approach can easily be tailored to meet a wide range of objectives. So the first building block is equity, and we know that equity performance can be volatile, but it has a strong track record of delivering positive real returns over the long term. So it's an important tool to help meet the long-term objective of protecting purchasing power and growing assets in real terms. It's also relatively simple, and it's straightforward to access a globally diversified portfolio for relatively low cost. For these reasons, we feel that it should form the foundation of any return-seeking portfolio. The next building block I've considered is alternatives. Here the word alternatives is used to cover a wide range of potential asset classes, but really what I'm referring to are investments that aren't publicly traded, as a result are much less liquid than equities. They tend also to be more complex, and that they require greater due diligence from fund managers before making investments. Now, charities are often true long-term investors, so are in an ideal position to introduce a bit more complexity and illiquidity to their portfolio, in the expectation that these asset classes will deliver strong real returns. So some alternative asset classes to consider here are private equity, infrastructure, and property. Infrastructure and property in particular are attractive because a large portion of the revenue generated by the underlying assets is contracted, so we can expect relatively stable returns over the medium term. These contracts will also have direct inflation linkage, helping to achieve an inflation plus investment return, and can also contribute income to the portfolio. The equity and alternatives building blocks are potentially volatile, and in the case of alternatives can be difficult to sell. We therefore want to avoid scenarios where we're forced to sell these assets to meet short-term outgoings, potentially at depressed prices. The third and final building block is therefore the fixed income and liquidity portfolio, and is designed to meet the majority of the charity's income needs. The foundation of this portfolio is an allocation to investment-grade corporate bonds, and these provide a contractual income stream with a low risk of default. Where extra return is needed, higher yielding credit can be used to top up income needs. So lastly, it's difficult to meet large capital expenditures from income. So it's worth ensuring a holding of a low volatility, high liquidity asset. Now, cash is an obvious choice, but it may also be appropriate to use short-dated, high-quality credit over slightly longer time horizons, beyond around 1 to 2 years.